Balance of payment. What is the capital account? What is the current account? What is the financial account? Why do foreign reserves increase even when a country's exports are higher? Why do countries sell gold and take loans from the World Bank? What is balance of payment deficit? What is balance of payment surplus? What is the effect of balance of payment on monetary and fiscal policy? How did India handle the worst balance of payment crisis in 1991? Balance of payment. Transactions are with foreign countries. Of goods, services, financial assets, and transfer payments. The sum of current account plus capital account plus financial account is equal to 0 according to the balance of payment, but it is difficult for countries to achieve this. In this equation, disequilibrium arises due to 5 reasons: cyclical disequilibrium, secular disequilibrium, structural disequilibrium, temporary disequilibrium, fundamental disequilibrium. Cyclical disequilibrium arises due to business cycles: recession, expansion, bust, boom. Secular disequilibrium arises due to factors like population growth and technological changes in a country. Structural disequilibrium arises due to a mismatch between labor skill sets and companies' labor requirements. Temporary disequilibrium arises due to seasonal fluctuations and economic shocks. Fundamental disequilibrium arises due to dynamic factors of a country such as market concentration, price, demand elasticity, and government regulations. Balance of payment. What is capital account? The capital account measures the inflow and outflow of capital in a country. FDI, foreign direct investment. Foreign companies invest in the domestic country. FII, foreign institutional investors. Foreign investors invest in the domestic country's financial market. External commercial borrowing. Foreign residents take debt from their own country. NRI, deposits. Foreign residents deposit money in their own country's banks. The sum of FDI, FII, external commercial borrowing, and NRI deposits constitutes the capital account. What is current account? The current account shows how much net income a country earns through imports, exports, remittances, gifts, donations, foreign aid, and investments. A part of the current account is the balance of trade, which is the balance between imports and exports. Exports minus imports. A trade deficit occurs when imports are greater than exports because more money flows out of the country through imports compared to money coming in through exports. In a trade surplus, exports are greater than imports because more money flows into the country through exports and less money flows out through imports. What is balance of payment financial account? It tracks financial transactions such as gold, currency, derivatives, equities, and bonds between residents and non-residents, including claims and liabilities toward non-residents. Foreign direct investment, foreign countries investing in the domestic country. Foreign portfolio investment, foreign investors hold domestic countries' assets such as stocks, bonds, and cash equivalents. Financial derivatives is how much foreign currency is invested in domestic country. Reserve assets are foreign exchange reserves. How many external assets the central bank holds as reserves. The sum of foreign direct investment plus foreign portfolio investment plus financial derivatives plus reserve assets. All these forms the balance of payment financial account. Why do foreign exchange reserves increase even when a country's exports are higher? Foreign currency does not come into a country only through exports. Countries' foreign reserves do not depend only on the current account. Foreign direct investment, foreign institutional investors, external commercial borrowing, NRI deposits. These are several sources through which foreign currency enters the domestic country. If these sources perform well for the country, as they have for India in recent years, then the country's foreign currency reserves increase even when there is a trade deficit. Why countries sell gold and why they take loans from the World Bank? Reason is balance of payment deficit, from which the current account comes. If a country's exports are more than its imports, then the current account will be in surplus and foreign currency reserves will also be high. But if a country's imports are more than exports, then the current account will be in deficit and foreign currency reserves will be low. The capital account is also a part of the balance of payment. If more money is coming into the country through FDI, FII, external borrowing, and NRI deposits, then the capital account will be in surplus and foreign currency reserves will be high. But if less money is coming in, then the capital account will be in deficit and foreign currency reserves will also be low. Having high imports and less money coming into the country, these create a balance of payment deficit. If imports are high, exports are low, and less money is coming into the country or more money is going out of the country, then the country will have to sell gold or take loans from the World Bank to buy foreign currency in exchange for domestic currency. Balance of payment surplus. Exports being more than imports, having more foreign currency in reserves. This means current account surplus. And more money coming into the country through FDI, FII, external borrowing and NRI deposits, having more foreign currency in reserves. This means capital account surplus. The sum of these two creates a balance of payment surplus. If a country has high foreign currency reserves, then it will not need to take loans from the World Bank nor sell gold. How balance of payment affects monetary and fiscal policy. For example, expansionary monetary policy increases money supply and reduces interest rates. Money supply increases in the economy. If the price of goods bought from other countries becomes relatively cheaper in the domestic country, then imports increase. Due to this, a balance of payment deficit occurs. And the government conducts fiscal policy. Like contractionary fiscal policy, in which taxes are increased and government expenditure is reduced. Money supply in the economy decreases, so consumer spending also decreases. Because of this, imports decrease. Due to this, the current account surplus increases, which leads to a balance of payment surplus. If, due to policy actions, consumer spending increases, then imports also increase. Because of this, the balance of payment surplus decreases and imports increase, leading to a balance of payment deficit. Interest rate also affects the balance of payment. If interest rates decrease, businessmen take more loans and produce more. This increases exports and creates a balance of payment surplus. But if interest rates increase, businessmen take fewer loans and produce less. This reduces exports and creates a balance of payment deficit. How India handled the worst balance of payment crisis in 1991. India implemented many economic reforms and policies. Among these, devaluation was one. The government reduced the value of the currency compared to foreign currency. Because of this, foreigners received more Indian currency in exchange for $1. This made Indian products cheaper, and foreigners bought more products for fewer dollars. This increased exports. A trade surplus occurred, and the balance of payment was corrected, which had gone into deficit. Contractionary fiscal policy was also implemented, increasing taxes and reducing government expenditure. This reduced consumer spending. With imports decreasing, the current account surplus increased, and the balance of payment was corrected, which had become highly deficit. India also made some trade agreements, due to which tariffs, customs duty, and trade quotas were removed. This increased exports. And the balance of payment was corrected. That's all about balance of payment. Don't forget to subscribe to the channel and press the like button for more such detailed videos.